Right, good morning, everyone. Thank you for joining us today. We're just going to give it another minute to allow people to join in case they're having issues with their connectivity. And then I'll do a quick introduction and hand us over to JB Smith, our guest speaker for today. All right. Thank you so much for joining us today. I'm Andrew Smythe. I'm one of the investment advisors here at NMG Benefits. And it gives me great pleasure to invite you today because these webinars are actually a perfect opportunity for us to do information sharing with you and to try and give you a sense of what is actually happening out there in the markets and with investments. They're incredibly important. And often when we look at our investments, we look at what's happening in the markets, it's hieroglyphics, it's sort of code that needs to be decoded properly for us. And that's where an expert like JB Smith will come in. So the wonderful world of investing, if you've been in investments for the last few years, 2021 was a nice year. 2022 was incredibly tough for some investors. 2023 had a lot of volatility to it. And then towards the end of 2023, the markets seemed to be picking up quite nicely. However, that's not the full story. JB is going to unpack it for us in a minute. And I just think it's incredibly important that we think about the world of investing and how many little factors go into it, from interest rates in America to local conditions here in South Africa. There's a lot that will help a fund achieve its goals for the year or fall over for the year. So it gives me pleasure to invite JB Smith. JB is the founder and he is the managing director of Sequoia Capital. It is a discretionary fund manager. Their job primarily is to give us low-risk funds and low-risk solutions for our clients that will achieve the goals in the long run. So JB, would you like to take over and then share our presentation with us?
Morning, everybody. Thank you, Andrew. Thanks for the introduction. Yeah, so geez, we are in February only, and it already feels like it should be April, May. So this year has actually gotten off to a bang. So what I want to do today is I want to cover a couple of topics. So I want to just do a bit of a review of last year. And I want to do that also by way of just opening the bonnet of the vehicle. So just give it insight in terms of what happened in the various markets. Then I also want to spend a bit of time on some of the key elements going into 2024. What is going to be important, and how that's gonna affect our markets. Look, markets are dynamic by nature. And we need to be able to adjust accordingly. But also in markets, you need to expect some amount of volatility. You need to be prepared to sit through that volatility. And I do have one quite interesting slide on our local market for last year, which I don't think people actually realize that, and which actually just brings home the concept of it's about time in the market and not timing the market. So let me kick off by, let's do a bit of a recap of last year. So if you look at last year, the big was inflation and interest rates. We started, and the whole talk of last year, also the way inflation is going to go down, when do we expect interest rates to kind of stabilize out? And that also had an effect on markets, especially when you look at what the market is pricing in versus what the various central banks are talking about. And that had a pronounced effect on financial markets. So what I'm showing in front of your screens now is 4 panels. So the top left panel is essentially let me just get my point here. The top left panel on this side is our local assets. So it's the last 3 months and 1 year, and this is all up until the end of December last year. So this is for 2023. Up until the end of 2023. The bottom left panel is again local assets in rand terms. That's for longer term, 3 and 5 years. And then the 2 panels on the right is for our offshore asset classes. Also for 3 and 1 year, and then longer dated. And that's also in rand terms. So if we kind of focus on the whole year, you can see essentially that most of our local asset classes were clustered together. It varied between, let's call it, almost 8% for our local equity market to about 9.7% for bonds. Property did have a standout year last year, but you need to take in context that property has been actually struggling and lagging for some time. So if you look at property, the 5-year figure for property, so property is still sitting on a negative or a flat return for a 5-year basis. So there's still a lot of catch up that needs to happen within property markets. But overall, our local asset classes were quite clustered. Together, and this actually had an impact on portfolios, specifically your typical balanced portfolios or small portfolios, in the sense that their returns would be closely clustered together. Because whereas a balanced portfolio would have a lot of equities in it, and a little bit of, let's call it, bonds and cash. And your stable portfolios will have a lot of bonds and cash and low equities. But you can see, because of the closely clustered together, the returns would have been the same. But later on, I'll kind of delve a bit deeper in our local equity market, just to get a sense of within our equity market what actually happened. If we look at foreign assets, last year essentially was quite a bumper year for global equities. Global equities up astonishing 31%. And this is after rand depreciation added to this. And then if you look at bonds and offshore cash, also coming in about also clustered together in terms of 12%. And if you kind of look at going into this year, what's going to be important? So we kind of moved from talking about how inflation might impact the trajectory of interest rates to what's going to happen with global growth and what impact will global growth have on interest rates. And again, the quite important element to this is what is the market pricing in, and what is the various central banks, and more specifically, what is the US Federal Reserve, what message are they giving to the market? So as I said, I would just want to lift up the car bonnet and just give you an overview of what happened within the various equity markets. So again, I'm showing you two panels. At the top panel is essentially global equity markets, and it's a base currency of that index. So what I mean is that the red one is our market, the JSE, that's in rand terms. All the others are in dollars, except for the orange ones, which is the Japanese market, and that's obviously in yen. Now, I've broken it down between the 4 quarters of last year and also then the full year. Apologies, I see this up until the end of Jan and not December. So, but the view is kind of the same if you look at the panels of last year, if you look at the quarter. So we kind of got off the year to a good start. All the markets did well. So you can see what I'm showing here is our local equity market. It's the MSCI World. So it's World Index, which is predominantly developed markets. Then we've got the emerging markets. We've got the S&P 500. That's then the small caps in the US. The yellow one is Europe. The orange one there is the Japanese market. And then we've also got China. So the first quarter, we got off to a good start. World equities did well. Our equity market essentially were in line with emerging markets. Then came the second quarter. Japanese market just did extremely well. It was up by astonishing 16%, and this is where China started to turn. So the Chinese market lost about 10% in the second quarter. The third quarter, essentially all equity markets were down, except for the Japanese market, which were slightly flat. And then for the last quarter of last year, the markets, again, everybody was up. Our market essentially just kind of tracked what the emerging markets did. So you can see emerging markets here in green, it was up by 3%. Our market was up slightly higher, but again, the Chinese market essentially lagged in the fourth quarter. So the two standout markets, essentially from a market point of view, essentially is Japan, Japanese market, and there are two specific reasons for that. So the one is that first of all, consumer spending actually increased in Japan. For decades, Japan had no inflation, so the consumer essentially had no incentive to spend. Because if you've got disinflation, think about it. If you've got disinflation, it means that you can buy your TV set next month at a cheaper price. So you're holding back your spending. Where Japanese, for the first time in decades, they've got inflation coming through. So now consumers are spending now instead of waiting to spend at a later date. That's the first reason. Second reason is Japanese companies have been buying back quite a lot of their stock. There's quite a bit of scrutiny that happened within Japanese markets and Japanese companies to ensure also that they improve the book value of their businesses, which helped the stock market tremendously. On the flip side, we've got China. China essentially, and I think it's one of the big disappointments of last year, is that we all expected at the beginning of last year that China, after, remember, they lagged in terms of COVID. So we all expected the Chinese market would kind of tick up once COVID has been lifted and once this whole consumer spending starts to filter through to the economy, which eventually did not happen. And the main reason is that it seems that Chinese authorities, unlike the West, the Chinese authorities essentially assisted businesses and not the consumers. So you remember the West in COVID times, they actually assisted the consumer. They gave money to the consumer. In South Africa, we did exactly the same. We gave money to people. We're still giving money to people as it is of today. And that essentially filtered through into the Western economies, but not so much in the Chinese economy. And then the bottom here is our local equity market. Now I've broken it down between that's the all share in red. It's the financials index in blue, it's the industrials in green, and then the resources in orange. So what you can see is resources essentially have been negative the whole of last year. And that's got quite a big impact, the Chinese impact on resources and the impact that the Chinese equity market has on our resources. But what I want to point out is to focus on our financials index. So you can see our financials index started slowly and it started to pick up steam. And essentially on a full year basis, it was one of the best performing sectors in South Africa. Now, we always like to look at the financial sector, especially banks, as the barometer of what the sentiment is for our local equity market. And the reason is why is that if you look at our banks are not allowed to invest offshore or to own companies offshore. So they can only do business in South Africa. So anything that's got an impact on South Africa, that will be filtered through into the bank stocks. And you can kind of see how sentiment slightly has started to change in these stocks. Also because these stocks were extremely cheap and they were offering extremely good valuations and dividend yields. Hence, investors starting buying up all of these stocks. But as I said, there's something that's quite interesting of last year, which I actually want to just point out. So it's a couple of charts, but let's just focus on the top one. So the top chart is a line chart of last year. So you can see our equity market essentially ended at about 8%. But what I've done is I've broken it down into three components. And that's the three panels at the bottom. So the first panel is for the first 2 months of last year. That's January and February. And you can see our market was up almost 5%. So it actually went up in Jan, it came down in Feb. But all in all, for the first 2 months of last year, the market was up almost 5%. Then, if you focus on the panel on the right, now that's for the last 2 months of last year. So that's November and December. You can see our market was up a astonishing almost 12%. So essentially, that middle part, the vast majority of last year, that's from the 1st of March until the 31st of October, our market was down almost 7%. You can see that line chart. We started in May, and the market just kind of ended off in a negative territory. So what this implies that if you've been fully invested for this whole year, you would have actually gotten the full value of this 8% of the market last year. If you had invested in October last year, then obviously you wouldn't have done that well or invested in this middle part. But this also brings me to the point that keep in mind, investing in the equity market is a long-term investment. You cannot view this investment on a monthly or even a yearly basis. You need to at least have a 3 to 5 year investment horizon if you want to have we want to have exposure to equity markets, but also your level of equity exposure will also determine your investment horizon. Also, what I want to do is just look at the offshore market and provide a bit of insight in terms of what happened in the offshore market. So last year was basically a year of two halves in the global market. It was either you did extremely well or you didn't do that well. So and I want to explain this by way of charts. So what I'm showing in this chart is essentially the blue line is the world index. So it's the index excluding emerging markets. It's the developed market index in US dollars. And the light green line is emerging markets. So you kind of see that developed markets vastly outperformed emerging markets last year. But you need to delve a bit deeper to understand what's the driver of these performances. So what we did is we stripped out the US market and the Chinese market from these charts. So we took the blue chart and we stripped out the US market. And we took the emerging markets and we stripped out China. And it's these two red lines right in the middle. So essentially what it implies that the rest of the world essentially were close to one another. And it shows the impact that the Chinese stock market had on, and the US stock market had on markets overall. Had you invested in China a lot, you would have slightly underperformed. Had you invested solely in the US, you would have slightly outperformed. But one also needs to understand the US market a bit more. So what we've done is we've taken the chart at the bottom left and we've just overlaid this pink dotted line is the S&P 500 index. And you kind of see the world index follows the S&P 500 index. And it's just a testament to the influence of the US market on world stock markets. But we all know of how well technology stocks did last year. And especially 7 specific stocks, which we actually call the Magnificent 7 stocks. And if you look at the impact of those stocks on return, so it's exactly the same chart you're seeing. We just now overlaid those 7 stocks. So that's Google, Meta, which is Facebook, Microsoft, Tesla, Nvidia, Amazon. So it's those big stocks we've just essentially overlaid. You can see how extremely well they did. So when you look at equity markets, you kind of need to delve a bit deeper to understand what actually drove this markets. But also, it's also the same in terms of emerging markets. So what I've charted here in US dollars, essentially is a couple of emerging markets. So the best performing emerging market last year was Brazil. Second in line was India. There in the middle is the emerging market basket. Our market is the one in red in dollar terms. That's Turkey, and that's the Chinese market. So even within the emerging market basket, it was quite a divergent set of returns, and your positioning would have had influence on your performance. So getting to this year, what are the views for this year? And we actually joined a global Goldman Sachs conference about 3 weeks ago, and one of the big questions was, what are the biggest risks to the global economy for 2024? So maybe I'm going to give it about 10 seconds. So just think to yourself, in your mind, what do you deem is the biggest risk to the global economy in this year? And this was the outcome at that conference. So by far, the biggest risk to this year in terms of the global economy and affecting the global economy essentially is geopolitics, followed by the US elections, and then obviously what's going to happen with inflation, and is there going to be a recession? And I'm going to touch on each of these. So the first one obviously is, is the US going into a recession, which will have also an impact on the global economy? And I'm showing 2 charts here, just to illustrate this whole view and this whole risk in terms of the global economy. So the first one at the top is, what is the market? The probability of the US going into recession within the next year. So the blue line is what essentially is Bloomberg, the market consensus. The light blue one is what the market is pricing in, and then the orange dot is what Goldman Sachs, their research, is indicating. So at this stage, it's only about, if you look at the market consensus, about a 45% probability. Goldman is sitting at a low 15% probability. But I think one need to take into consideration the trajectory of this probability. So we started way above 60, about 65% at the beginning of last year. And as the year progressed, this probability of a US recession essentially just started to subside. And the reason is for this is that if you look at the bottom, the chart at the bottom, this essentially is the US GDP growth, the expectations of US growth. And you kind of see how this has started to pick up. Again, the red one is what the consensus is in the market. So you can see that essentially came from about flat to about 1.5%, where Goldman is pricing it from about 1.5 to 3%. So let's just forget about the absolute numbers, but just the direction of these two lines, which essentially indicates that the US market is stronger than we initially thought. And this essentially has got implications for interest rates. So again, at the same conference, the question that was asked is, when do you expect the Fed to start, actually some of the central banks to start cutting rates? So if we focus just on the blue bar, so that's the US. So the majority expect the US, the Federal Reserve, to only cut rates now in the second quarter of this year. So this is about May to June this year. Now this has changed substantially. If we think back to last year, November, December, and let's show you how well the markets did. That was because the markets at that time priced in a rate cut in the first quarter of this year. Then these stronger economic data started to filter through into the US market, and this whole expectation shifted to the second quarter of this year. And it's actually better illustrated in the chart below. So we are currently sitting here. So what it's telling us is that the market essentially is pricing in about a 60% probability that the rates are going to be cut in March this year, which is it isn't high enough. But if you look at May, in May, they're essentially cutting a 98% probability that rates are going to be cut. So as it is now, I think the expectation is that the US will start cutting their interest rates around about by May, June. But that's going to be highly dependent on macroeconomic data in the US. Is the inflation going to come down closer to that 3% level, the core inflation, where the Fed wants it to come down? And what does that imply for the South African economy and our interest rates locally? Unfortunately, it's difficult to see our Reserve Bank cutting our interest rates before the US cut their rates. And the reason why is that, and I'm not sure a lot of people realize this, but although our Reserve Bank's mandate is to get inflation down, stability of our pricing or our interest rate, our exchange rate is also critically important to them. So they do notice that. So if we start to cut interest rates before the US cut their rates, we might have the possibility that our currency can weaken further, which has got further inflation implications for our local economy and for South Africa. So it's quite difficult to see our SARB cutting rates before the US cut theirs. So I think once the US cut their rates in May and June, if that happens, then I think we can open up ourselves for a rate cut locally, but not before that. Also, it's important when the US start to cut interest rates, it's important to know what the reason is for cutting interest rates, because that will have a pronounced effect on markets. So what I'm showing here is, again, is two charts, and let's focus just on the top one. So the top one essentially is the S&P 500 index, and it's a bit of research done by Goldman Sachs. So it shows that what happens to the S&P 500 after the Fed has cut the interest rates, and they give it the reason for that. So if we expect a recession, we expect that the US economy is going to go down, it's going to be poor, they are going to go into the recession, and for that reason the Fed start to cut interest rates. It's this red line. Then one can expect, based on past data and experience, that the S&P 500 and by extension the global equity markets will at best go sideways or be negative. And it's quite explanatory why this would happen. It's because if you cut rates in a recession, it means something is wrong. Companies are going to don't do that well. But the flip side is, if we kind of start to cut rates because we just need to normalize interest rates. So we're not cutting because we're going to go into a recession. We're just bringing rates slightly down, and we're bringing them down slowly. Then one can expect that markets will tick up. And that's based on past experience. That's why the reason why you cut interest rates is extremely important. Then if you look at bonds, global bonds, again, the red one is a recession. If we start to cut interest rates for a recession, and due to a recession, then essentially one can expect that bonds would do well. So this is quite inverse. It's the yield of a bond. And keep in mind, when the yield of a bond decreases, means your price of the bond increases. So you make a capital gain. And it's quite similar to when we are cutting interest rates, because we expect growth is still going to be good, then you kind of would expect that bonds would slightly improve, but you might have experienced a bit of volatility. And if you kind of look at this in a different way, so apologies that this chart might not be that clear, but essentially what I'm showing is that the first one on the left is and this is based on the world index. It shows you that what happens to the world index when the Fed essentially starts to increase interest rates. So a lot of data, but if you focus on the black and blue line, essentially it shows you that your markets normally essentially does well, all else equal. And the reason why is, if you think about it, when do we normally increase interest rates? It's when the economy is doing extremely well. It's heating up. Companies are doing extremely well. So that's still gonna continue. Then this chart is essentially, this chart on the right represents where we are now, and that is when we are kind of nearing the end of the cycle, and when we're starting to approach that point where we're going to start to cut interest rates. And you kind of see it base case essentially, and kind of it's where markets are flat. And this is where the reason why you're cutting is so important. So you need to know why you're cutting interest rates, as illustrated by the chart at the on the left. Now the bottom panel indicates that what happens to markets at the last rate cut. So when the Fed is basically done cutting rates, you can see that data essentially in history indicates that markets then also do well. And that's because all the bad news has actually filtered through the markets into companies, and stock markets essentially now the pricing in the cheapness of credit and the cheapness of money. Then if we kind of move over to elections, so it's going to be a massive year in terms of elections. I'm just indicating here all the upcoming elections this year, all the countries that's going to be holding either parliamentary elections, presidential elections. Now, if I say parliamentary, that's normally where it's a prime minister. So I think about 60% of the global population will be voting this year. Of course, the biggest one for the market and global economy is the US election, which is going to be in November. We've also got our election, and hopefully we'll find out somewhere soon when that election will happen. It has to happen before the beginning of, well, I think the 5th of August. So hopefully we will get a date soon. What is going to happen in our election is it's really it's going to be a fascinating election. There's a lot of offshoot parties that's going to come into play, but it's also irrespective of our election, the US election is going to have a massive impact on global markets. And if you look at the US election as it is now, so this is a poll that's been taken in the US, and it's between the 3rd and the 9th of January this year. And the question was asked to Americans, if they chose the president at that point in time, would they choose? And it's kind of a toss-up. I mean, 35% went for Joe Biden, 35% went to Donald Trump, and 30% essentially said that they don't know. Obviously, Donald Trump hasn't been nominated as the Republican candidate, but as it sits now, he's got about an 80% approval rating and the probability that he is going to be the Republican nomination. I just also want to mention, keep in mind, as we near the US election, there's a lot of opinion polls and data and analysis that's going to show the probability of who's going to win. But history also shows you that the sitting president always has a lower probability than the new incoming president, or in this instance, not the new one, but the other opponent. So let's for one moment, let's assume that Donald Trump wins the election. what are the things that we can look at? And when you analyze something like this, you kind of focus on 5 things. First one is physical policy. What's going to happen to tax and regulatory policy, trade policy, monetary policy, and then geopolitics. I'm not going to go into all of them, but I think the most important one is going to be trade policy. And what is going to happen there. Now, if you kind of, I think we're in a fortunate position we in this scenario, we kind of experienced Donald Trump already for one term, and we know how hard he was on trade policy. So, and if he kind of keeps that up and kind of start imposing trade tariffs, then you can kind of expect that the dollar will strengthen because money will start to flow into the US. The flip side also is that if you look at physical policy, if you kind of start to tinker with physical policy, then again there's an impact on the US dollar. Then also geopolitics. We know the impact of what a Donald Trump stance can have on geopolitics. But also just want to emphasize the fact that you cannot position a portfolio for a geopolitical outcome. We have talked about this in the past. Geopolitical events has got quite a binary outcome. It is extremely difficult to position a portfolio for that. It's better to kind of understand what impact a geopolitical event can have on markets and what that transition mechanism is that's going to filter into markets. That's the best way to kind of try and analyze a geopolitical event. So we kind of turn our attention to markets and how we view markets. And I'm showing a couple of panels here, 4 panels. So the top 2 is essentially more your global markets, and it shows you the price earnings ratio of markets. So price earnings essentially indicates the expensiveness or the cheapness of markets. So the one on the left here, the line chart is the world index, the price earnings ratio. So, and the green dotted line is the average. So if the gray line is above the green one, it means markets are expensive. If it's below, it means markets are cheap. Now, if you kind of break this down into regions, so if you look at the bar charts now, the green line is the long-term average. That indicates where we are in terms of expensiveness and cheapness. The blue diamond is the current position at the end of last year. The gray bars is the highest and lowest it has been over the same time as when that average was calculated. Now, if you look at the world index, it correlates with the chart on the left, so it's slightly on the expensive side. If you look at the US is sitting on the expensive side, and we kind of looked at the US, and it doesn't matter which metric you use. The US market essentially is sitting on the more expensive side. If you look at Europe, it's kind of fairly valued. The UK it's cheap. Then you kind of look at the emerging markets, which I'll touch on at the bottom. And these are actually quite important when you look at markets. Now, for the US to be expensive doesn't imply you shouldn't be invested in the US at all. No, it actually implies that you need to look at maybe a specific manager that can pick out the winners for you, or maybe just have slightly less US exposure than your benchmark. And if you look at the charts at the bottom, we're moving to emerging markets. So it's a similar indicator, but here we're just using price to book. And you kind of see that emerging markets are slightly on the cheaper side in terms of their long-term average. And if we kind of move over now to the region specific, if you look at China is expensive, is on the cheap side. But if you look at South Africa, there's our market. Our market is quite cheap. But although our market is cheap, we kind of need to be aware of the fact that our companies, their profit margins aren't as good as it was in the past. And you kind of need to factor that in. But also with emerging markets, important thing to consider is their currencies and where their currencies are sitting. And this is what this chart essentially is showing us. So on the y-axis here is essentially the price to book. So it's this measure. Now on the bottom here is the currency of that emerging market. So if you're sitting here in terms of currency, it means your currency is expensive. If you're sitting here in terms of equities, it means your equity market is expensive. So if you're sitting here, it means your currency is cheap and your market is cheap. And there's South Africa. So our currency is cheap and our market is cheap. So all that we need in our market is just a catalyst that will ignite our market and just push up our market to levels and to valuations where it ought to be. This is quite important when when you're analyzing emerging markets, to take this currency overlay into consideration. So how do we kind of put all of this together in the context of a portfolio? And what I'm showing you is a bit of research done by three chaps by the name of Kinlaw, Kritzman, and Turnington, and they essentially broke down the return of a portfolio in terms of their drivers. And they said that 57% of the return comes from your default asset mix and your investment to invest. The next 27% is the securities you select. So in our world, the managers we select. And then the last 16% is those subtle small tilts we make in portfolios. So what does this mean in the context of a portfolio? So I've taken here a conservative portfolio and a balanced portfolio. And what you're seeing here is the asset allocation of these portfolios. So it's the strategic asset allocation of the portfolios. So if you look at a balanced portfolio, strategically, it's 46% SA equity. So these asset allocations represent this big blue chunk, that's 57%. So what it implies that if you invest, you kind of just stick to this, then that's 57% of your return. You can add to this by choosing the correct managers within each of these asset classes. So within a local equity component, having the correct managers, that will theoretically add 27% of your return. And then the last 16% is by making subtle changes. So instead of being at 46, let's be at 40 or 39%. And a little bit more in offshore equities. That will add a little bit more to your return. So, and we take all of this, all the market valuations, what's happening in the macro economy, we kind of apply this on top of this framework. So, how are we currently positioned in our portfolios? And I've shown this per asset class. Now, I've indicated in terms of neutral, and then slightly underweight or slightly overweight. Now, what does neutral mean? Neutral means these allocations. It means if we're neutral SA equities, it means we're at 46. If we're neutral offshore equities, it means we are at 22%. If we are slightly underweight SA equities, then we're sitting there about 40% for a balanced portfolio and about 15-16% for a local portfolio. So we always apply this in the context of our asset allocation, which is that big chunk of your return. So as it is now, we are slightly underweight SA equities. We're slightly underweight SA property. Our bond market, we're slightly overweight. We think our bond market offers good value. Our income assets, cash assets, we're neutral in that. Offshore equities, we are sitting neutral at the moment. We're slightly above neutral as the market has drifted. But within offshore equities, there's a couple of markets that we specifically like. So we are slightly underweight on emerging markets within offshore equities. But we do like Japanese equities, so we've got a specific allocation towards Japanese equities. In the US market, we do like your smaller cap companies, smaller capitalization companies. So we do have quite a specific allocation to a manager that can seek those opportunities for us. Offshore property, we are slightly underweight, but I just want to mention that with our local property market, we are slightly going to start closing our underweight position ever slightly within the next couple of months. And then offshore bonds, we are overweight offshore bonds because we feel that offshore bonds do provide good value as it is, and also as soon as the dollar starts to depreciate, the rand is going to strengthen. And by investing in bonds and locking in your returns now, it means that you can essentially make up currency losses from a rand strengthening by investing in bonds. And why is that? And I'll showcase this by virtue of this chart. So just focus on the red triangle. So these are the US bonds, the 10-year US bond. We are currently sitting at a 4.5%. That means that if you buy US bonds now, you're locking in a 4.5% yield in dollar terms. But if this yield goes to just to 4%, so why would the yield go to 4%? Is when the dollar starts to depreciate, it means people will start to put money, also move money, pull money out of the dollar and start buying bonds, and will push this yield down. This will mean a capital appreciation. That means you can easily make 8% on a movement like this. And that's why we do like a bit of offshore bonds. And then just to close off, just in terms of portfolios, what portfolios do we manage? So now, I don't specifically name a portfolio because being part of the NMG group, we do manage quite a lot of various portfolios, but that kind of can be clustered into the following types of portfolios. So we do manage income portfolios where there's no equity at all in those portfolios. We've got, let's call it stable, low equity portfolios where we are strategically will have 20% in SA equities and 16% in global equities. And this portfolio will typically, all else equal, be about 25% offshore. We do have balanced portfolios, which has got 46% SA equities, 22% in local equities, and about close to 30% offshore. Then we've got two types of global portfolios. So our physical global multi-asset portfolio won't have any SA equity. It can go up to 75% in offshore equities, and it's fully offshore. Or you can get a type of balanced version of that. We've got 26% in SA equities, 46% offshore, and about 54% offshore. And then we also do manage a SA equity portfolio that invests only in local markets. But we've also managed $3 portfolios that's physically money offshore, and they fall into this kind of stable portfolio environment. Keep in mind, these will totally be offshore, so they will have no investments in our local market. And that is it from our side. And I really would welcome any questions that you might have.
JB, thank you so much. I mean, you were really unpacking a lot of hieroglyphics for us, and just, you know what, it gives me and all of us a sense of all of the intricate decisions that you have to make, all of the data that you have to sift through the entire time before you start adjusting portfolios. I think the big story last year most certainly was the big tech, and what big tech had on global markets. I mean, you spoke earlier on about the Magnificent Seven, and those are 7 of the biggest technology companies in the world. So many of us investors might be sitting thinking, well, perhaps now I should just put my portfolio in technology as much as possible. Well, frankly, no, you shouldn't. There's still a lot of risks, and we're still looking for a clear indication for interest rates to come down in America, and then they can start coming down in other parts of the world. So up until then, I think it's really important to have a good asset allocation and an asset mix in your portfolio, no matter what it is, and then ride out the storm and allow people like yourself to rather do the asset allocation and the blending of the portfolios behind the scene, rather than us trying to time the markets. We get the markets wrong, and then we can actually suffer some losses. So on that, it looks like around about May, possibly May, June, somewhere there, that interest rates might start coming down. I think at March is probably too soon for interest rates to start coming down at the moment.
Yeah, Andrew, it's essentially, you are correct. I mean, as I've mentioned, it's difficult to see our market, our SARB cutting rates before the US. And it's a pure fact that if we do that, then and you kind of think of it, if we cut our rates before the US, it means that investors will earn less on our money, and they can still earn a lot more in the US. So what's going to happen? You pull your money from South Africa, you invest it in the US, which essentially imply our currency is going to depreciate further. And if our currency depreciates further, it means that it filters through to inflation. Our inflation rate is going to be sticky and higher for longer. So at some point in time, we will need to reverse that decision and raise interest rates again. So that's why it's quite difficult to see our rates coming down before that of the US.
And I think that's quite important, because there are clients of ours that are in income portfolios or yield portfolios, and they've probably still got a few months to go achieving good quality outcomes before interest rates start coming down. And it all does depend on America. When does America start cutting her rates so that the rest of the world can then follow suit and cut their rates as well?
Yeah, no, definitely. As long as interest rates stay high, clients can earn a decent yield from income portfolios. But within all the income portfolios that we manage, we also use what we call a flexible income managers, where in those flexible income managers can essentially buy a bit of bonds as well. So keep in mind, same way that I illustrated the US bond market, the US bond market can benefit from when rates decrease and that deal decrease, so you get a capital appreciation. The same applies in our local bond market. So essentially what it implies that even if interest rates start to decrease, our local market, some of our managers now on all the flexible income portfolios that we look after will benefit from that. So the investor will still benefit in a decreasing interest rate environment.
Yeah, I've got a really good question from TC Faria down in the Western Cape. It says, in your previous sessions, you emphasized the importance of exposure to Japan and China. Are you still bullish on Asian stocks, given the poor data from China? And if I can just add to that, it looks like China is scurrying around at the moment, trying to support companies, as you said earlier on, and hopefully has some kind of flow through to their citizens as well. I mean, yes, China's taken a huge knock, and part of that actually filters through to South Africa as well, because we're a commodity producing country. So even though we've got Transnet issues where we're trying to export as much as we can, there hasn't been as much demand from China just recently. So given everything that's just come about in the last week or so from China, what's your feeling on China and China starting to come to life again?
Yeah, so I think just in terms of Japan, we do still favor Japan. Now, when I say favor Japan, we don't have a additional 15% above our benchmark in Japan. We've got slightly above benchmark in Japan, so we're slightly overweight Japan. One reason also we still favor Japan is the yen, because the yen is a kind of natural hedge against a weaker dollar at some point in time. But if you look at China, China is quite fascinating. So the biggest problem in China essentially is their property market, and that's where the brunt of the downturn in the equity market can be centered upon. One of the biggest property developers was essentially closed down, or it was liquidated, which is a company called Evergrande. But so what we need from the Chinese authority is a lot more stimulus, not more rate cuts. We did have that at the end of last week. They cut their rates by 50 basis points. That's only due to come into effect in a couple of weeks' time, but they've already announced that. Also over the weekend, the Chinese authorities came out with what they call a whitelist. So what they do is specifically targeted to the property market. So they analyze certain projects within companies, and then they financially support those specific projects of a company. So they don't support the property company, so they don't give blanket money to the property company. They give money for a specific project of that property company. So in terms of China, we need to see more of that coming through. It is gonna take time for that to filter through. If you look at Chinese valuations, China is extremely cheap. I mean, it's at probably a decade low. It doesn't necessarily mean you need to be overweight China. Essentially, we have been in the portfolios we manage, we have been decreasing China slowly. I think we sold out of a bit of China about 2 weeks ago before this last leg down. But we're still exposed to China via the benchmark. So we had benchmark weight. We're not overweight. So, but at some point in time, there will be the opportunity to kind of increase your Chinese exposure. The one thing that also can be a catalyst to that is this whole shift from Latin America to China. So Latin America did extremely well. So Brazil did extremely well last year. And at some point in time, one can expect markets and investors to start rotating from Latin America into the Asian economies. Of course, vying for capital in the Asian economy is the Indian market. So they did experience a bit of a good year last year, but the valuations aren't where the Chinese stocks are currently sitting.
Okay, yeah, really good question. I mean, we mustn't forget the enormous GDP that China is. And once interest rates can carry on being cut a few more times, then we're going to start getting we'll start getting a lot more pull through from China onto some of the South African resources. So that'll do well for our resources as well. So yes, things can be cyclical. Very definitely they can be cyclical. And I think we all want to try and be the wolf of Wall Street to make money as fast as possible. But as you've seen from the data, there are a million landmines all the way through this. You have to navigate. You have to keep your risk down. And that's, I want to just speak about risk at the moment. A client of mine sent me a scam. She wanted to know the message that she had got. Is it a scam or is it for real? You'll be surprised to know, to the people listening to us, that about every single week, the FSCA, the Financial Services Conduct Authority, puts out a mailer about a new scam or people to watch out for and so on. So particularly when times are tight, people are looking for an easier way out when money's tight. So if you come across anything that looks like a scam, please bounce it off us. At NMG, we've got ways of checking it immediately. And try and keep your risk down for the next few years. In fact, try and keep your risk down for as long as you're an investor, because it's nice to ride the wave when it's up, but it can be awful when the market turns against you. So I think with that, JB, thank you very much. We're going to have our quarterly investor presentations. I think that they're incredibly informative, and it gives people peace of mind that while they're sleeping, we're working behind the scenes and making sure that things run as smoothly as possible. So JB, thank you very much, and then we'll catch up with you again next quarter.
Thank you, Andrew. Thanks for the opportunity, and thanks everybody for joining us. It's always a pleasure to talk and share. And if you've got any questions afterwards, if you think about another question, please feel free to reach out to us. We will gladly assist you, gladly answer your questions. I mean, the one thing is we are quite an open book, so we prepared to share any and all information that we've got. If you want to spend a bit of time on the portfolios, have a look inside the portfolios, I mean, please reach out to us. We will gladly share any information.
Okay, thanks, JB. Enjoy your day.